ramifications or the implications of the reappointment of Dr. Addison, Governor of the Bank of Ghana, on the market is Andrew Takyi-Appiah, CEO of ZP. Andrew, welcome.
Thank you.
Great to have you once again.
I'm obliged, as always.
Now, let's look at where we were yesterday, and then today and tomorrow.
Okay.
Now, prior to the coming to office of Dr. Addison, how would you describe, or what was the state of our banking sector industry in Ghana?
Okay, so I always like to take it from two perspectives. There's fiscal policy, fiscal economy, and monetary policy, monetary economy. Central banking is about monetary policy, monetary economy. So if you have a strong monetary policy environment, you will have a strong fiscal policy environment. They go hand in hand. They're like twins, basically. Let's take it from just prior to the election of the appointment of Governor Addison. You find that we had reached a point where the market had plateaued. We're having serious liquidity crisis, and it was just consistent bailout, or what we call life support to the banking industry. Market conduct had come out of the market. Risk protocols had come out of the market, and were just in forbearance. The market regulations had gone into forbearance. Now, if you look at when Governor Addison came into office, the first thing they did was to make that monetary policy environment effective, is to go into compliance. The first thing they do is to appoint, for the first time in Ghana, a compliance governor. So our second deputy governor is a very strong compliance person from career, from background. That means that, first of all, you're going to look at market conduct risk. Financial conduct risk is very necessary. We want to have a very strong policy environment from a monetary perspective. One of the things to make sure you have is right capital adequacy, you have the right compliance behaviors, you have the right governance structures. So then the next thing he does is to introduce the strong governance, rotation. MDs must leave after a certain number of years. Governance structure, even all the way at board level. Okay, that all comes in to make sure that whatever policies you implement will be effective. Then the next thing you look at is look at the market adequacy, look at liquidity, look at banks that are basically running on life support and need to be fixed. Okay,
now before you continue, Andrew, I'm not just interjecting, but if you take poor corporate governance, one of the key things that we had, and he rolled out some policies to streamline the inflation there. What do you mean by corporate governance in that sector?
Okay, so all comes back to conduct and conduct risk and conduct risk management. Corporate governance being weak is the fact that, one, sometimes governance at the board level was not strong enough to make sure that executives are compliant. So there's poor compliance, we're delinquent in compliance, which is why we lead all these loans, the NPLs, the bad structures that we had. I mean, there were banks who didn't even have, whose capital adequacy was in negative predominantly, and have been operating as regular banks taking deposit. That is bucket risk. It's only a function of time, and the market will crash. So actually looking at it from that perspective was very necessary. Now, what did they do? They institute board changes, they institute managing director changes, so that we make sure that all these managing directors who have been around for a while will go, so that there's also effective governance. Not to say some of them were bad, because we've had very wonderful managing directors like Anandani, but we needed that change to smoothen the economy. The second thing they did, which I thought was very critical, was rather than watch for us to go into liquidity crisis as a market, quickly come and say, look, I'm going to give you banks 2 years, some of them 1 year, to actually fix your balance sheet, make sure your capital adequacy is the right balance, and then I'll allow you to operate. Even but we're moving capital up.
To some, 400 million was too huge a sum.
Okay, 400 million is actually nothing. For a look at economy the size of ours, even before rebasing and after rebasing, our GDP is in excess of $60 billion plus. So if you look at the economy from that perspective, 400 million is little to run the market per bank, considering the fact that, don't forget that every single bank, whatever you give out, you must also charge it in your book. And that's one of the things that, so that I can just focus, that's one of the things that he brought into the market, the conduct risk. That says that there will be penalties if you do not make sure your capital adequacy is relevant. There will be penalties if, for example, you take a loan and you don't take charge on it. Okay, it was necessary to take all that delinquency that happened in the market. Now, people think that shutting down the banks might have been a wrong move, but it gave them enough time to fix their books. So traditionally, central banking will not just shut the bank down. Most banks that were shut down were probably warned even before the governor came into office. The governor just took the bold step to execute to make sure that we have a strong monetary policy and policy environment. Now, in doing that, they also brought in a bailout. For the first time it happened in the market, most markets to be on shareholders. So at least they were quite considerate. Most markets will be shareholders and their families who will suffer. This time around, they came in with a fiscal economy to support that. Now, the dividends from that, Bishop, as you're seeing, is that now you saw we've had strong market stability. When he came into office, inflation was about, if I'm correct, last summer, it was about 12.715%. In 2017, they brought it down significantly to 9.810% based on who's recording. This came down to 2019, 7.1, 7.6. You see that it's a downward trajectory. Obviously, what happened in 2020, where it went up to about 10.5, 10.1, 10.5, it's obviously beyond them. The global economy melted. Ghana went on a meltdown. There's not much we can do at that point. And also, if you look at the supply chain cycles dropped. And I'll explain that. Orders we made in 2019 December will not come until probably March, if you're lucky. February. Sorry, if you're lucky, March. Otherwise, it will come in June, which obviously contributed to a trade surplus. But because they managed the economy well, we also saw the benefits of that trade surplus.
Yeah, but to the average Ghanaian out there, the name and is synonymous to collapse of banks. We've seen banks that, in our view, were dual: UT Bank, Unibank, Beige, Construction, sovereign banks. These, local banks were, merged. Some of them were merged, and we now have Consolidated Bank. Some were put under, GCB. To the average Ghanaian out there, he collapsed bank. I've lost my job. What would you say to that?
Well, so maybe 5,000 people lost their jobs, but over 100,000 people had their deposits. That's my point. So he protected the economy rather than just leave the economy at the mercy of shareholders. And that's positive. So actually, I think it's probably propaganda and lack of education. But if they have proper market insight, and that's your job, you, the media, must make them understand and appreciate the safety hatch that they put into the economy. They didn't just leave us at the mercy of shareholders or banks.
But someone would say that we've been doing that before he came to office. It was, these banks were there, and whatever was going on well to them. So why would you come and then say, Charlie, close the bank because you don't have what it takes to run a bank? Well,
because the average consumer is not aware that a lot of the money floating was paper money. We call it balance sheet money. You see it on the financials, but they are not involved. So they don't exist. They don't have obligations. They don't have instruments supporting them. What I might mean by instruments is if you see some kind of treasury or some kind of fixed deposit or investment, you should have a corresponding entry. That means that the money is sitting somewhere. A lot of these banks didn't have it. That's why you had a lot of life support. When the central bank is giving you 60 billion in life support, 20 billion, 3 billion, 4 billion, then there's a problem. When central bank is given life support money and it's being used to set up other banks, then there's a problem. Then you don't have a bank. You understand? You actually, there's no capital in the bank. It's a peppercorn. It doesn't exist. And it will vaporize, and that's what happened.
So what happened? Why is that those his predecessors couldn't take that bold decision to crack the whip and do the right thing?
Well, a part of it is political, part of it is regulatory. Like I explained to you, forbearance. Some political parties, by nature of their play, tend to a lot more forbearing. So if you look at the Kufuor administration, we went into serious compliance. Governor Takyi-Appiah fixed the economy. We had look, at some point in 2008, I would change $1 for a cedi, 1 to 1, okay? But President Mills comes into power, and he goes into forbearance. Obviously, it will come from cabinet. Regulatory will have a certain influence. But as you know, fiscal and monetary go hand in hand. Not to say they are bad guys. Sometimes the market needs forbearance so that it can pick itself up. But we had reached a point where the delinquency levels were too high. The liquidity risk for the market was too high. So they needed to go into full compliance. And what you do is conduct risk. If you don't go into conduct risk, you will not have an enabling policy environment. And look, you can see it. Over the last, my business, I deal in Forex a lot. Over the last 3.5 years, the CD's rate of the dollar against the CD, the appreciation rate has been very, very well managed and controlled. The financial market has been very well managed, very well controlled. We don't see the free falls we used to see. We've also moved away from the regulatory delinquency where we come in and we just pump in dollar, lose on the market, but we've stabilized the market for about 3-4 days. We have seen a lot more effective stability in the city to dollar economy.
Yeah, if you're talking about the forex market, if you look at it critically, that is from 2017
yes.
to 2020. It's like to the dollar 8.40%.
Yeah.
But prior to that, 2013 to 2016 is about 22.24%. What was it? I mean, what were they doing right to be able to achieve these?
Well, I think first of all is the discipline. The discipline. Secondly is the money market, coming into the money market and making sure that as a regulator there's fair play. And also, like I said, coming in with the right policies. Some of them insisting on the reference rate, breaking the market into 3 and saying that those who are allowed to do price discovery should do it and do it with conduct. And those who don't do price discovery should also oblige with conduct. Conduct means doing it the right way and doing the right thing. The right thing is not pushing the market the wrong way. You see what I mean? Also enforcing, de-dollarizing the economy, which was very necessary. A lot of time in the past, everything is dollar, we pay with dollar. But insisting on CD payments against dollar was a good thing. The other thing they've also done is to take out the bad banks. You see what happened with the bad, any market that is arbitrage for forex, and Ghana is a pure arbitrage market. What will happen is that when banks are in delinquency, what they do is they become rogue. They play on the high end of the market. So they trade in forex, pushing high rates, having high offshore liabilities for their LCs, and creating a market problem. So they come in and insist that no, we're not going to do that. Shut these banks down. What do you see? You start to see a lot more stabilization. Of course, granted, 2017 we had a liquidity squeeze in Ghana. It was quite difficult. But by 2018 we started to stabilize. By 2019 we're on the right trajectory. You've seen it. It even affected inflationary rates. But then you're seeing that by the time we get into 2020, it will change naturally because of the global meltdown.
Now let's look at the issue of fintech. We've seen that interoperability and all those regulation reforms, that's how fintechs come up.
Yes.
For him being reappointed, what does that mean for the market?
Well, I think first of all it's a good sign. One thing I predict he's going to do is to bring the fintech, or what you call the EMI, the mobile money economy, into the capital market. And how are they going to do this? I suspect strongly they're going to introduce a digital currency, which is not masking the local currency, but what it is that if we have $1 billion CD in circulation, you might have 200 million in digital, the corresponding in physical cash. When that happens, what you're going to see is that all of a sudden, that 35 billion plus float that moves in mobile money will be able to come into the capital market. When it comes into the capital market, it's good, because then all of a sudden, banks are able to trade that as well. All other players are able to trade it. It sits in the domestic treasury. You see, today it's sitting outside the domestic treasury because it's not currency. And I suspect they'll do that. And why would they do that? Because the first thing they do is to regulate the fintech environment. Then the second thing is to set up all these, and first thing is to set up the act, the enabling policy. And the next thing they do is to regulate it. Once they have regulatory stability and innovation and compliance are at par, then the next thing you're going to do is that. And that's where we're going. And the moment we do that, then it puts Ghana on a higher pedestal, which we already are anyway. So I think it's fantastic. I also think that for the first time we've got a very strong governorship. We have a strong economist. The governor himself is one. You have a very strong compliance governor. And what they've done is they've reformed the central bank. You see, growth starts from within. When you reform within, you're able to extend it outside. And you see it. Regulatory officials have become a lot more compliant. They've become a lot more conduct focused.
NPL and non-performing loans after October was at 15.4%. But prior to that, that's by 2016, we're doing 22-23%. It's still on the high side.
Well, it is. But one of the issues or causes is obviously the impact of COVID-19. A lot of the NPLs we have seen are COVID-19 NPLs, and rightly so, because look, the economy went into shutdown mode. Before lockdown, obviously, just because of the corona, we started to experience decline, a contraction in the economy. Lockdown brought us on a contraction. post-lockdown, recovery has been slow but consistent. You would expect that the schools will have a problem. Every supply chain that is dependent or driven around children, schools, manufacturing, anything that couldn't have people work or be in the same communal environment for too long, would it be impacted? But I think that if you look at policy rate, it's been consistent. The trajectory is very well balanced.
14.5.
Right. Well, on average, about 14.1, 14.5, 14.6. You see, it keeps coming in and out. But it's also because even in the height of the pandemic, they came up with a conduct policy around the pandemic and how loans should be managed. So on one hand, you have a governor who's looking at regulatory, monetary, but also caring about the domestic economy. A lot of times you can only do one, but he brought a balance in. That's a good governor. That's the kind of governor who can take us to the next layer.
But one would say that even the 14.5% policy rate, I go to the bank, lending rate is too high. We now enter into the African continental free trade area.
Yeah.
Traders in Ghana, can they compete with their counterparts elsewhere, even manufacturers?
Well, first of all, I'll answer you in two parts because there are two questions. I think that obviously naturally in our parts of the world, there's always a short supply of deposits. What the government has done again is to expand the economy. And the steps they've taken to expand the economy, the reforms they brought not only to high street banks, but savings and loans, rural banks. They've put more money into the economy, working with the fiscal environment, fiscal policy members. The next thing they're going to do as we're going into the next phase is to make sure that the capital market will have an entrance from the mobile money environment. That will bring in a lot more deposits into the ecosystem, which we need. So on one hand, that balance will come. It's from the days of Kwame Nkrumah, it's a challenge we've had, but they've managed it more. I mean, for you to shut down banks and build them out, and build customers out, depositors out, and still be able to stabilize the liquidity of the market, it's very rare that a governor or a government is able to do that. On the next point, will we be able to compete in NAFTA? I think so. I personally think NAFTA is designed for Ghana, because Ghana has moved away from extractive to semi-productive economy. Yes, we're still largely dependent on import, but for the first time, our market will become the epicenter for the zones. If you look at the West African Monetary Zone, or even the larger West Africa, Ghana will become that market that everybody is dependent on. One, because we have open and accessible ports, trade will come in. Beyond that, you're also going to see things like traders coming from Ivory Coast, Togo, etc., coming to pick from our market to sell on the other side. The plans that President Akufo-Addo has introduced to improve the railway, moving Amewu there is a great idea, would also help, because then we're going to have an aid track that will go across West Africa and the larger Africa. So I think that the markets to look out for in AFTA will be Kenya, Ivory Coast, Nigeria, Ghana, South Africa, what we call the King's market. And Ghana, I believe, will dominate it because we have an arbitrage economy, we have a well-stabilized currency to the dollar compared to the other markets, and it's not hedged against the euro, like the off markets.
Now, in a sentence, how would you describe his reappointment for those in the market out there? What kind of confidence does it exude?
Okay, well, look, it's a difficult question, but I think that if you ask me from observation of the market and all the efforts they put in, I think that you're looking at somebody who consistently cares about the average consumer. So you're going to see a lot more improvement in policy. You're going to see a lot more downward trend in policy rate, which hopefully they're going to enforce to make sure that the banks also do the right thing and the banks price them adequately so that we, as the average consumers, will benefit.
So you've not done anything that you think needs to be improved upon?
Well, innovation is improvement. It's a function of every day. I think they do that as a central bank. Even just the reforms within alone, it's a big thing for me.
Thank you, Andrew, for your time sharing this with us. And this has been Market Avenue. We've been looking at the impacts or the implications of the reappointment of Dr. Ernest Addison, Governor of the Bank of Ghana, on the market. And to Andrew Takyi-Appiah, the reforms brought to bear upon the system has helped to engender growth and even confidence. And Ghana is better placed to play a major role in the African continental free trade area. My name is Edward Nyakon. God willing, we'll meet again. Shalom.